Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, it's been another dramatic week for markets and indeed humanity as the impact of the US election result starts to reverberate. In purely financial terms, Donald Trump's victory has sent bond prices plunging and shares soaring, continuing a trend seen in recent weeks. We'll be discussing the fallout later in the show. Let's not forget we're still less than 10 days on from the budget as well. And to top it all, the Bank of England has just cut interest rates for the second time this year. Today, our economics writer, Hermione Taylor, is here to talk through the implications of that decision, what the budget means for government spending and the cost of borrowing, and what higher bond yields mean for the country and for investors too. We're also going to look at companies' initial reaction to the increase in employer national insurance contributions announced by Rachel Reeves last week, and the particular significance that may have for retailers. Alex Newman and Julian Hoffman are here to talk about that. We begin, though, with one of the UK's quality shares, one of its most profitable businesses, car marketplace Auto Trader. Fundsmith Terry Smith, who we speak to in our interviews podcast this week, available on our usual channel, is perhaps something of an admirer of the company, which we'll touch on in a minute. But before that, Mark, there were results out this morning. What did you make of them?
Yeah, and the results themselves weren't terribly well received by the market. The online marketplace said that the vehicles have been sold at a faster rate than at any point in recent history, which ostensibly you think would be a positive thing. But unfortunately, this has been combined with a shortage of stock. Cars are selling very quickly at the moment, and that doesn't directly affect the business model as such. But as fewer cars are being produced, coupled with the change underway, the switch to electric motoring, it's analogous in a sense to a housing market where you've got a shortfall in supply. It sort of underpins prices to a degree, but eventually that supply side issue it doesn't translate into a positive outcome for the company itself, and so the Auto Trader now they expect average revenue per retailer the growth to slow down over the second half of the year. So while it's not disastrous, it points to perhaps a wider trend that the company may have to deal with because of the aforementioned transition.
Mm-hmm. What they refer to as their stock lever in relation to how quickly things sell, don't they? Which is effectively a year-on-year measure and relates to inventory. And also, I think, when things are selling so quickly, Auto Trader, a lot of its growth recently, which we'll come on to, has been in add-ons and other things it can sell, retailers, that kind of thing. It's in some ways a bit harder to do that when things are just appearing and disappearing. But let's talk about its routes to continued growth, because this is a tight marketplace. It's a marketplace in which it's very dominant, which is why it's such a profitable business, why it's done so well over recent years. Of course, the onus is always on future growth. One thing it's been trying to do, it has been to introduce more of these additional things that it can sell to customers, but in a way that it adds more functionality as well. So I think that's its strength, really, in that these aren't just add-ons that customers have to pay more for and they find their prices going up. There's more functionality with them. One of these things is the Deal Builder project, which it thinks can really add to that average revenue per retailer. What's it been saying about that in these figures?
Well, the first thing I'd say, it mirrors the sort of conventional forecourt auto traders in a sense, because all of those, or the successful ones at any rate, have been increased, giving a full service offering in a sense. And it's their after sales, for instance, that is the most profitable part of those businesses at the moment, because obviously when you're acting as an effective wholesaler, you've got a fixed profit rate margin there. The Deal Builder project that enables a car buyer to value their part exchange, apply for finance, and reserve a car on Auto Trader as well. So again, it's a value add offering, and it's worked out pretty well for them, judging by what's happened over the past 10 months. I mean, it's still in its infancy as such, and they're waiting to see how this is going to how able they will be to sort of monetize this over the long run. But the number of deals involved in this has increased by tenfold during the period under review there, and it stands at about 23,000. They've got 1,500 retailers signed up to the arrangements at the moment, and they're seeing growth there. But what difference that's going to make to revenue stream isn't quite clear as yet, but it's certainly looking encouraging.
Mm. There was a note they made in relation to that because, as per the way you've outlined it, this does relate partly to car finance, and they did say in the results that clearly there's a lot of issues with car finance at the
Yeah,
moment.
yeah.
They say we're making the relevant changes in our leasing journey to disclose and capture consent for commissions, historic commissions being the subject of an FCA investigation right now. They don't think changes to Deal Builder will be required. They do think the market developments will strengthen their position as an aggregator, as an independent aggregator of car finance, which is plausible, but we should
Yeah, it
mention.
looks like anyone dealing with car finance at the moment going forward will have to disclose the rate of commissions involved with any other incentives too, which shouldn't be a problem for a company like Auto Trader. But there's probably a few dealers out in Essex that are slightly nervous as a result of it.
Indeed, indeed. Well, yeah, there is this tight market. There's an increase in the number of unique cars being sold, but not increase the overall stock or the stock lever, as we say, due to the speed of sales. Bit of a mixed backdrop at the moment, but why don't we look at perhaps the overall limits for growth over the medium to long term? Clearly, they're looking at these add-ons. What do we think about how they progress the business? On the one hand, there's this Autorama leasing business they've bought, which has had some problems itself.
Yeah.
Why don't we start with that to begin with? What do they say about Autorama?
Well, in the short term, it's going to be dilutive in terms of the margin as well. But again, I think it feeds into this full service offering thing that they've got the leasing arrangements covered now as well. And it was kind of inevitable that these add-ons will happen from time to time with the company too. But as I say, short term, it's going to sort of constrain profitability to a small degree, I guess, given the overall size of the business. Limits to growth. I mean, are they going to be able to expand beyond the core UK market as well? That would be a consideration, and it's difficult. I think it's a business that relies necessarily on the digital infrastructure, although probably that's that's obviously valuable within itself. It's the arrangements the commercial arrangements they have in place, and it gets to the point. I think Phil Oakley made this point a little while ago that the strength of the business is its strength. If you're looking to sell automobiles, then it's a first port of call, and you feel somehow that you missed out, or that if you took any other avenue, you might be at a disadvantage, which is it's kind of an intangible thing in a sense, but I think it does hold true.
The limits to growth part, the reason I asked that as well, because this was something Terry Smith said. I think in the past, Fundsmith have mentioned Auto Trader as one of 5 businesses that on purely financial metrics would meet their qualifying investment bar, albeit they're such a big fund that they can't really buy a mid-cap stock now. But Terry Smith did also highlight the geographical limits to their growth insofar as he doesn't really see them expanding geographically, having an almost limitless potential by moving from country to country, which is fair enough as they are a very UK-focused business.
Yeah, it's not similar to a digital model where where it's scalable. It does come down to those existing arrangements which are built up. I mean, that provides a moat in a sense, but it also means that growth is likely to be incremental.
I wonder, I mean, I'm not sure, to be fair, but if there are businesses like this in other countries, they could look at and effectively acquire in that way. The other thing this brings to mind in terms of, and they're quite often compared as well, is Rightmove, a company in a very dominant position in the UK market, the platform, the feeling if you're an estate agent, in that case a car dealership, that you'd miss out by not putting your business on the platform. Rightmove, of course, had some bid interest earlier this year, and Auto Trader has in the past as well. So given where we are with the amount of bid activity in the UK the past few years, I wonder if that's something that could return at some point too.
Yeah, I mean, there's been private equity interest for both companies. I think you go back to, I think it must be 2015, 2016 for Auto Trader. But, since then, they've been in a sort of acquisitive mode themselves. But yeah, I mean, it wouldn't surprise me in the least if either or
Mm,
got within the crosshairs again.
mm.
I should point out as well, looking at Phil Oakley's article from a while back, another really good point he makes that the risk factor for the Auto Trader at the moment is a lot of manufacturers are actually moving to an agency model, or some manufacturers are moving to an agency model. The Korean automakers have been doing this for a while, of course, and it mirrors a trend across industry in a sense. Uh, so, I mean, that's something that investors should be looking at going forward.
Yeah. There's also the shift to EVs, of course, which I think, as Phil also said, require less servicing, so that could be a problem on one level. But on the other hand, that does suggest there'll be even more focus on the used car market for dealers to make profits, which again could play into Auto Trader's hands.
Yeah, I wish I could shed some light on that as well. But I mean, I'm looking at this week to week. What's happening within the EV market? There's been a slowdown in the growth of EV production that we've seen. We're going through that at the moment. Presumably, over time, when economies of scale kick in and technology improves, prospects for that second-hand market with EVs will improve. But at the moment, I would just be guessing to say where the market will be in 6, 12, 18 months from now.
Mm. Well, won't we all? What about the valuation then? Let's finish on that.
Yeah,
Auto Trader tends to be fairly premium priced valuation-wise, as you'd expect given its qualities, but equally that does suggest perhaps it's a classic long-term compounder rather than something's going to see dramatic growth. How do we see the valuation at the moment?
yeah. Hence the relevance of your comments regarding Terry Smith as well,
Mm.
because if you're buying in at a full fat valuation, which it is at the moment, then you're doing that on the basis that you're going to see consistent earnings growth, and that should be factored in. I mean, it's all in the share price at the moment. It's 25 times consensus earnings, with a dividend yield of 1.4% and implied of 1.6%. So on the face of it, yeah, I mean everything's in the share price there, but it's a quality stock, and it, the market in the UK is still healthy, even though it's facing some of these problems linked to the transition, and I guess with interest rates heading in the right direction as well, that's a positive for the business too. So.
Mm.
Um,
Indeed.
well, the shares were down by about 6% when I looked last time, so it's going to be a 6 out of 10 for today's results.
Indeed. That's fair enough. Well, let's turn now to retailers in general. We're looking at the impact of the budget changes announced last week, specifically the increase in employer national insurance contributions, which, coupled with a minimum wage increase, is going to affect retailers quite significantly in some cases. I think it's fair to say we've seen a few noises on this front this week. Alex, why don't we start with you, because a couple of companies, M&S, Spoons, maybe we'll get to, have mentioned that this week, but you were listening to Sainsbury's analyst call this morning, which was also quite interesting.
It was, yeah. The analyst call revealed quite a bit more than the headline figures and commentary in the actual results. So maybe if we can just take a step back first and just kind of recap on exactly what those changes are and what they mean for both companies, employers, and specifically for retailers. So the two big headline figures are that the minimum wage is up, I think, 7% to about £12.21 for employers over the age of 20, and it's something like 16% for workers aged 18 to 20. National insurance contributions go up about a percent and a bit to 15%, but the minimum threshold for contributions, I think, drops quite considerably. So it really has a pronounced effect on lower wage employers. Like-for-like rises of around 10% on total employee costs, I suppose before wage inflation that might be coming in, are really to be expected now. So this was a really hard budget for retail to swallow. Turning to Sainsbury's, the CEO, you could see in the analyst call, is sort of like the most animated when it came to the subject of the budget. He said that changes to national insurance, particular, he said, were very significant. That's going to mean an extra £140 million on Sainsbury's employment costs next year. And they don't break down in the interim results the employee costs, but I was looking at the annual report, and I think they paid something like £646 million in the last full year. So it's going to be, this is above a fifth of a jump in that line, and that's before wages go up next year as well. So lots of costs coming. And the CEO made the point that the margin structure of the industry being around 3%, this is quite a lot for retail or hospitality to absorb. They're going to try as much as they can to absorb costs rather than just pass them on to the consumer. But looking at the various commentary across the sector, both sort of leaked in various press reports and stated overtly, it appears that there is, it is going to be a mix. There is going to be some pass-through inflation to consumers where retailers, like, for example, to a degree, the supermarkets feel that they can do that, and others are just going to struggle to do that because they're under such pressure already.
Yeah, I think that's fair to say. Julian, what's your take, maybe looking at the pubs in particular? As we've said, Wetherspoons have made some comments on this week as well. Similar industry to traditional retail in that margins can be pretty low and a lot of minimum wage employees, so therefore those costs are rising too.
Well, I mean, people will be surprised that Tim Martin was complaining about this. It's an interesting one it is an area where you can have a certain amount of sympathy for anyone trying to run a pub at the moment. The problem is that margins are wafer thin, and even a marginal hit to or increased costs can wipe out some substantial bits of profit, at least on an individual level. The interesting thing about Wetherspoons is although they're talking about 60 million of additional costs related to coming out of the budget, around half of this is national insurance contributions, which it now has to pay extra for each staff member. And the other half it defines only as general business costs. So it's difficult to quantify exactly what those are. But he says that he won't be putting up prices in the short term for his business. So they obviously feel that they can absorb it rather than risk their pricing structure, which I thought was quite interesting. I mean, he also got his 1p a pint reduction, so maybe he's not too annoyed about that in the long term. But for companies that don't have the scale of Spoons, those kind of cost increases could be quite significant for other parts of hospitality. And indeed, it seems that some will be putting up prices in response to it.
It was interesting. The OBR said the headline amount raised for this for just the national insurance contributions was 25 billion, but the OBR in their forecast actually reduced that to 16 billion because of the fact they think wage increases will be lower as a result of these increased costs. But of course, when you're looking at these kind of businesses with a higher minimum wage, they don't have that leeway, as it were. So that's a factor as well.
And they also might just disappear. I mean, that's the other thing has to take into account. I mean, if you're talking about pubs and hospitality, particularly the fact that at least a pub a week closes somewhere in the country, and that the number has halved over 20 years. I mean, it does show that the way that people get around this is either by employing fewer staff or just closing up altogether, which is probably why the OBR is slightly skeptical of the headline numbers. When your costs go up, you find ways of mitigating it.
Mm. I thought that it wasn't so much the increase in the national insurance levy, but it was a reduction in the threshold as well for employers, which is a major problem apparently.
Yeah, as Alex was saying, you're right. It's not just that increase; it's the point at which you start paying it. There is a relief for small businesses, I think, which should hopefully help some small pubs in that they will be excused in some way these costs. But yes, that lower threshold is, I think, maybe accruing more income that way rather than in the 1.2 percentage point increase to the rate itself. One company which may be particularly affected, according to Peel Hunt, is Greggs, which they think, well, they say that in-house manufacturing, because it's about a third payroll, therefore is about a third of costs, they will probably have to put up prices, which will be an interesting one for them. They probably have some leeway to do that, given they're very keenly priced, but at the same time, that price point is a big part of their attraction. So it'll be interesting to keep tabs on that as well. I mean, it's a difficult situation, isn't it, really? I think we all knew that some tax increases were coming, and the government obviously boxed themselves in with their manifesto pledges, but at the same point, they've got to raise some revenue from somewhere. But that doesn't mean it's going to be successful or work out in the way they intended. So we will see what happens. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Let's turn now, though, to the overall, perhaps, fiscal outlook post-budget, because there's a lot of spending announced. There's a lot of measures announced that could come through. We've also seen bond yields climb in reaction to the budget, but also in reaction to the US election and the anticipated US election result in the weeks and months before yesterday's actual outcome. Hermione, what can you tell us as a broad brush for starters? What's the overall sense of how the fiscal outlook has changed in light of the information revealed by the budget?
I mean, the first big thing is that Rachel Reeves really took pains to try and ensure that she kept something we kind of call fiscal credibility. So she's praising UK economic institutions like the Bank of England and the Office for Budget Responsibility, which is the government's fiscal watchdog. And so she tried to set a very different tone to the one that we saw in the mini budget a couple of years ago. She also pledged to stick to her two fiscal rules. So the first says that day-to-day spending cannot be met by borrowing, and the second says that debt has to be falling as a share of GDP by the end of the forecast. And she wants to tighten both of these up by changing that forecast period from 5 to 3 years. One of the biggest changes that she made from a fiscal perspective was that she loosened the second rule by changing the measure of debt to something that economists, I think they're trying to get a snuffle to catch on, but it's a public sector net financial liabilities, which is a wider measure of debt. And by doing this, she freed up some extra headroom for investment. And Reeves is actually going to use a lot of this headroom up. It was more than I was expecting, and I think it's a lot more than markets were expecting before the budget was announced. And this means that by 2029, she'll have about £15 billion worth of headroom left. And this is a very narrow margin. It isn't much more than Hunt had in March, and it's a lot less than average chancellors have had since 2010.
Yeah, there's a lot of longer-term implications as well, aren't they? The question of whether growth is actually going to come through from this budget. The OBR even is relatively skeptical, isn't it? Of course, you could argue, I suppose, there are some measures which aren't captured by the growth assumptions yet, partly because they're very hard to measure, such as what could happen from liberalising planning laws and also the long-term impact of some of the infrastructure investment. There's also the question of whether Labour will have to come back for more, or whether if growth doesn't come through, they will feel, or even if growth does come through, they will feel they need more revenue. They will look at the fiscal position and think more of this might be needed. But that's a story perhaps for another day. Let's talk about bond yields in particular, because we have seen quite a significant rise in borrowing costs over the past few weeks, as well as the past few months, accelerated again this week by the US election victory. What do we think that's going to do? Maybe we'll frame it in terms of the base rates. Of course, the Bank of England has just acted as we record. What do we think about that rise in bond yields and the implications there?
Yeah, I mean, you make a great point, and I think the things that you highlighted there are the things that are really worrying markets. So interestingly, bond yields actually ticking down while Reeves was delivering her speech, and her commitment to fiscal credibility and sticking to the fiscal rules looked really good. But then when she sat down, these OBR reports were released, and exactly as you say, once investors had a chance to look through this kind of deep dive into what the new policies would mean, there are a few things that started to worry investors. As you say, the new policies will kind of give a £36 billion injection into the economy by 2029. This will give a bit of a sugar rush. It will boost growth over the next couple of years. But the OBR also expects it to increase inflation. As a result, they think that interest rates will need to be about 1/4 percentage point higher over the next 5 years. I think markets really took note of this, and we're also worried by the lower headroom. She's got a very, very limited buffer, which, as you say, means that she might have to come back and raise more taxes to meet her fiscal rules. There was a really interesting kind of experiment that the OBR did in their report, which is where they worked out what it would take to erase this headroom completely. And if interest rates are just 1.3% higher than in the forecast, that headroom could disappear completely.
And what about the Bank of England today? Because it was only a few weeks ago, it seemed like we were going to perhaps get back-to-back cuts, one today and one next month. But it would seem that the combination of the budget and the impact on bond yields and other factors too might suggest that that's off the table for now. What are your sort of early thoughts, Hermione, on what they said today?
Yeah, I think you're right that a December rate cut does look less likely. So the Bank of England did cut by 1/4 point today, and the vote was actually it was 8-1. So only one member of the Monetary Policy Committee wanted to hold rates at 5%. I think we can't get too carried away with that. So the committee said that based on the evolving evidence, a gradual approach to removing policy restraint remains appropriate. And I think that's quite a good hint that December is off the table. I think it would have been quite a bold move as well, because by cutting back to back in December, they'd have sort of changed their cadence of rate cuts. So they'd have gone from doing one every other meeting to one every 6 weeks. I think because the budget is expected to put some upwards pressure on inflation as well, they'll stick to this more cautious pace of cutting in every other meeting, at least for now. So I think that indicates we'll have a hold in December and then a cut again in the first meeting of 2025.
Yeah, I mean, when you see the OBR saying that even by 2030 they expect the base rate will be 3.5%, there might be some fluctuations between now and then, but given we're only 1.25 percentage points above that now, it doesn't suggest a severe cutting cycle. I suppose the other thing we could mention, which we could have mentioned in relation to our previous segment on budget cost inflation as well for companies, is the things like the house builders, which have struggled in recent days, with Persimmon saying yesterday that cost inflation is coming back, citing some of those budget measures. But also, I think the fact that bond yields are rising, mortgage rates are going to tick up again, or have been, despite this Bank of England cut. We're seeing markets are reacting to rather different things at the moment. So it's quite hard to see today's rate cut at least having much of an impact. What about what do we think about that long-term progress of base rates? Does that change much from the budget or from what we learned in recent days?
Well, this is really interesting because the OBR in March thought that interest rates would be settling at about 3%. And they've scaled it up to 3.5%. And we've seen something similar happen with markets. So before the budget, traders thought we'd have interest rates at about 3.7% by the end of next year. This has changed now to over 4%. Lots of economists have trimmed their projections for rate cuts by next year as well, by shaving at least one kind of 1/4 point rate cut off their projections. So I think the broad consensus is that the budget has changed the outlook for interest rates, and we're not going to see as many cuts next year as we would have otherwise done. But if we start looking ahead to 2030, we get into a kind of much meatier bit of economics, which is where we have to start thinking about where interest rates are going to settle and what the right level of interest rate is to keep our economies ticking over once we're confident that this inflation spike has passed. This is a really big debate and very technical, but I won't go into it. But it is worth pointing out that no one thinks that this is going to be going back to zero again. So the March OBR forecast saw rates plateauing at about 3%. So even though there was an upgrade, it wasn't a huge one. It just kind of really reinforces that this era that we had before of zero interest rates is truly in the past.
Yeah, that certainly seems to be the case across the pond as well, doesn't it? I mean, we've seen shares, as I said at the top, going up, bonds falling. Maybe I open this up to everyone else as well. I don't know if Alex or Gillian, you have any thoughts on this, because that's been the initial reaction to Trump, as it has been over the summer. The belief that based on policy pledges, based on perhaps the spectre of tariffs as well coming in, that there will be more fiscal stimulus. There will therefore be more growth, perhaps more inflation, perhaps fewer rate cuts, albeit at the same time, he almost certainly will want more rate cuts. So for now, the reaction has been, this has been good for shares. There's also a corporate tax cut coming in potentially, bad for bonds because of the increased spending. I don't know if you have thoughts on any sort of sector-specific or even macro view on whether this is going to continue, or whether some of the contradictions might come out in time. I'm not sure.
I was looking at how pharmaceutical shares have performed, which, given the context of the election and the fact that the Wall Street responded so positively, have actually fallen over the last month, which actually increased in the aftermath of the election. And I looked into a bit and probed to see asked a couple of people what they thought was going on. And basically, there is a worry within at least the investors around pharmaceuticals that because that industry is so tied into global supply chains, which are often very expensive, very secure, because everything has to be certified by regulators. But the fact that tariffs may come in on things like reagents or specialist chemicals, these are global businesses. They buy things in lots of different companies, in lots of different countries, and bring them back to the US, say, to be assembled and sold. This could have a negative effect on not so much the bottom line, but the way that they have to run their operations. So you might see expensive reshoring trend continuing, which means that they might raise have to raise capital expenditure. So there are various worries around that, and also the strength of the dollar also plays into that as well. If the dollar starts to weaken a bit over the next 18 months, 2 years, then that has an impact on how where they generate their profits and the kind of FX, the FX hedges that they have in place. So it's quite a complicated. I think for pharma, it's quite complicated. On the other hand, there's no possibility that they'll be regulated in the US for medicines price regulation is not going to happen. So they can still charge basically what they want for their medicines in the world's biggest pharmaceutical market.
Yeah, we've seen a lot of disparate impacts already, haven't we, despite the overall market trend? Those tariffs, those supply chain issues could be quite significant. Novo Nordisk yesterday, which has had supply chain issues in trying to scale up the weight loss drug business in recent months, reported some pretty good figures and was up about 8%, I think, early, but then closed down, partly for the reasons you say, I think, Julian. And we've seen, you've got to consider the dollar, as you say, which currently has been going up in the initial reaction, but if you started to get credibility concerns, that might start to fall and as you say, have a different impact there as well. All these things are potentially up in the air now, aren't they? A different attitude to all number of sectors, which you've started to see play out, and we are going to cover in a lot more detail in print and online as well in the weeks ahead.
On a national basis as well, you've got to think about interest rate sensitivity too, because that relates in no small part to average mortgage multiples, and that's going to affect economy. If interest rates aren't going to fall as quickly as we anticipated, it's going to have more of an effect on some economies than others.
Absolutely.
So we have the certainty of who's going to be the next president. That in itself might explain the positive reaction in markets yesterday, that there is a trajectory. But beyond that, my take is that there's profound uncertainty with the second Trump presidency and its implications for markets. So there's obviously the tariff story, as Julian was alluding to, is a huge overhang for everything that a global business is going to be thinking about for the next 4 years. Whether it's a little bit closer to the first term, it's sort of a bargaining chip for extracting concessions from the big exporters that Trump always has in his sights, or whether he's going to double down and this is his second and final term and he's really looking to go to war on trade. The other question is that this sugar rush 2.0 of further corporate tax cuts, if the goal is to double down on American exceptionalism, just turbocharge the economy again, that excess demand that presumably that is going to create in the economy, where is that going to be spent? Potentially that's good for the global economy if that results in higher demand for exports around the globe. But at the same time, if there's this tension that they're going to get slapped with 20% plus tariffs, it's very unclear where that leaves everything. And then bubbling in the background, as ever, you just have the bond market just every year getting increasingly more nervous about the sustainability of American debt and the capacity for a Trump administration to significantly tackle that based on what they've committed to already. I know Elon Musk is supposedly in charge of an efficiency drive. That's placing enormous faith, I think, in his capacity to turn, he's done some big things, but moving the entire US government spending to a lower level, I think might be a bridge too far. So yeah, I think it's a moment of real profound uncertainty for global markets and America particularly.
Hence the gold price.
Indeed. Well, we will have to leave it there, unfortunately. I'm sure we could talk about this for much longer, and I'm sure we will in the weeks ahead, as I say, but we've run out of time today. So thank you very much to Hermione, to Alex, to Julian, to Mark, to our producer, Maddie Apthorpe, and thanks to you for listening. We'll be back